All right, guys. I'm Big Mike, and like always, I'd like to thank you for being here today. Today, the webinar is going to be about high-frequency trading, and we have Jerry from Telvent DTN, also probably better known as IQFeed, here today to talk about high-frequency trading. And he's going to kind of give us an overview. He's going to look back at the May 2010 flash crash. He wants to talk about data anomalies in the equity markets, E-minis, crude, etc., and also talk about the proposed regulations that might affect HFT and how HFT is affecting you guys as the typical retail trader or investor. Also, at the end of this webinar, we're going to be giving away 3 6-month subscriptions to IQFeed. For those of you that don't know, IQFeed is pretty much regarded as the best data feed that you can get as a trader. It works with pretty much every platform out there. I use it personally, as do a lot of people on the forum. And as part of the BMT 3-year anniversary, they're giving away 3 6-month subscriptions. That's normally $85 a month. It'll be free for the winners at the end of the webinar today. And so stay tuned. Be sure to pay close attention to what is talked about today, because the quiz questions at the end will be related to today's content. All right, as you guys have questions, just type it into the questions box, and we'll try to get everyone's questions answered. Give me 1 second, and I'll be turning things over to Jerry.
Okay. Thanks, Mike. Thank you for the opportunity to talk to everybody here. I've got Robert Carrillo and Eric Hunsader here as well. And Robert works with a lot of the IQ direct customers that a lot of you have spoken to. And Eric's done a lot of the research that a lot of you have read about on the various forums and websites for Nanex.net. We'll go over a little bit, like Mike said, a brief overview of what Telvent DTN is. Most people, like Mike said, knows us as IQFeed. But Telvent DTN, we've been around since 1984, providing time-sensitive information to traders, such as market data, news, weather information, to people to make financial trading decisions. We have over 120,000 customers in the financial markets, the agricultural markets, energy, and weather. In 2008, we were acquired by a company out of Spain called Telvent for $445 million. And then recently, last year, Telvent was acquired by Schneider. Schneider is based out of Paris, so we've got a very global footprint now from our parent companies. On the market data product side, most of you are aware of the IQFeed, but in addition to that, we have ProfitX. So IQFeed works with a lot of third-party software providers out there, and then ProfitX works with desktop traders, people that want to trade the commodities primarily, but also the energy markets too. And then our institutional platform is called Encore. So it's a full broadcast feed. So unlike the other two, IQFeed and ProfitX, which is a symbol-based, where you tell our servers what symbols you're looking at, Encore will provide you with the full market so you can spot different trading opportunities. And then in addition to the streaming products, we have web services, which will deliver snapshot data. So if you want to put market data on a website or a risk management application or mark-to-market, we have a web service for that as well. And then some customers that don't need intraday pricing, or they want to get a large number of symbols, we have text files that we deliver via FTP. So you can pull down one file for NASDAQ stocks rather than making a whole bunch of requests. It's a good way to update different portfolios at the end of the day, or scan the markets on an intraday basis too. So DTN's been around since 1984, but then we've partnered up with a company called Nanex. Nanex is a software provider, and we've been with them for a number of years. And their license, we partnered up with our data and their software. So the software processes the data, analyzes it, and then distributes the data out to our customers, who then write different applications on top of it. We're located at multiple data centers so that you can get good access to the market data. Nanex looked at a number of different data feeds out there before they partnered with DTN, and they really liked our ticker feed, what we did, our support, and they selected out of all the other data vendors to go with DTN. So the combination of the Nanex software and the DTN data we launched a product called Encore in 2005. It's the only product out there right now that delivers a full broadcast feed over a standard internet connection. Anybody else, you're required to either co-locate and spend the fees for that, or get a telco delivery. And with market data rates keep going up, that bandwidth keeps exceeding. So a lot of people now are up to gigabit networks, and for options even up to 10 gigabit networks to get that data. So with the Nanex technology, we're able to compress it down over 90% and send the data to you over standard internet feed. So you can trade that at your house or your office or wherever you're at, whether you're in the US, Europe, Asia, we can get the data to you. We provide the Nanex feed both real-time, end-of-day, and historical data. So a lot of the analysis that you're going to see here, if you've got any programming capabilities, you can get the data from us and do similar testing and build systems on the historical data, or then also go to a real-time feed. Using the Encore data and the API, like I said, you can build trading systems to spot different opportunities that you wouldn't see on a normal symbol-based service. A comparison between the Encore and IQFeed, you can see IQFeed has a symbol limit. It's between 500 and 1,200 symbols. With Encore, there is no limit. We just permission you by the exchange. So if you want NYSE, Amex, CME, NYMEX, OPRA, you can very well exceed 500,000 symbols that we can push to you. The other difference is the timestamp resolution. IQFeed is currently at 1 second. In Encore, we have a timestamp that goes down at 25 millisecond resolution. And also, with the equity exchanges, IQFeed, you're able to get the regional quotes on demand. So, for example, if you're looking at SPY or, say, Apple, you're going to get the best bid, best offer with IQFeed, and then you can request to see what the quote is for ISE or CBOE, ARCA. With Encore, we automatically provide you all the regional exchange quotes, so you get a good view of the entire market. For historical data, IQFeed includes historical data, tick level for trades, and then the quotes at the trades. With Encore, we will provide you the historical data as an additional service, but we have that data all the way back to 2004, not only trades, but also bid-ask quotes too. So if you want to build a back-tested model, you can get all the quotes, whether that's NASDAQ, or we also have CME data as well as OPRA data that you can get historical and back test. Another difference is the news. IQFeed has news, whereas Encore does not. Encore is primarily market data. IQFeed is market data as well as historical and news. Completely different APIs. IQFeed is a socket-based with ASCII strings. Encore, you have a DLL and just do a callback with the DLL, and you're going to get different message trades and quotes automatically streamed to you. The markets now are interconnected. You can't just trade one market without being aware of what's going on in the others, because they overlap a lot of spaces. So with equity trading, orders can be from institutional firms, or they can be from retail traders. So you're not only going to be trying to get a fill against another retail trader, but you're also going to be going against the big boys like Goldman Sachs, GetGo, Citadel as well. Whereas on the commodity side, you're going to trade the E-mini contract only at the CME. But with equities, there's 12 different exchanges and over 50 different marketplaces that you can execute an order. So not only the 12 equity exchanges, but that there's also ECNs or ATSs, alternative trading systems. There's dark liquidity pools, and there's also internal matching engines. So you've got equities, you've got futures, and the derivative markets too. They're all interlinked. So the ETFs, for example, SPY, will be looked upon based on the underlying 500 stocks, but then there's also ETFs that are leveraged 3 times, 2 times, and those also are good trading opportunities. So people will be playing different algos, and HFTs will look at those. Not only on the future side, but then you've also got options. Right now they just added a 10th exchange. So now there's 10 different options exchanges for you to trade those markets. In the futures, by far the biggest is the E-mini S&P, which a lot of you guys out there are trading right now. people will do different basket trades. They might trade the SPY versus the E-mini versus the underlying 500 stocks. We hear all different kinds of scenarios from our customers that they're trading out there. Here's an example of the different market centers. Just for the equities, you can see that a trade can be looped from one of the exchange to the other, and we've actually got a streaming version of this that I can send you a link to that shows you just a few seconds how fast orders are routed from one exchange to the other. Now we'll go into a little review of the May 6th flash crash. That was a big deal because the market was already down 261 points. So it was a down day to start with because of the Greece situation. But then at 1442, the market was down 413 points. And then in just 6 minutes, it was down 998. It was the largest intraday loss at that point. And people couldn't figure out what was going on. Then all of a sudden, 2 minutes later, it was back up to 666. And then at 1500, it's back to 455. So there's a huge swing there in just a few minutes. Nanex did a lot of analysis on this. They analyzed over 7 billion trades and quote messages to come up with some of the information that we're going to present here. They noticed at 1442 and 46 seconds, the NYSE bid started to cross the best ask prices for over 100 stocks. And it then increased just 2 minutes later to over 250 stocks. Why would this happen? The quote started lagging other market centers too, and the HFT started to pick up on this. When the market was falling, the NYSE bids were not dropping as fast as the other offer prices. So this allowed some of the HFTs that noticed this to send buy orders on one exchange and sell orders in the NYSE because they knew that the selling pressure was there, the NYSE prices were lagging. A lot of the HFTs saw that and knew something was wrong, and they pulled out of the market, and that even added more to the fall because the liquidity was pulled. There's quote bursts by the different exchanges. As you can see, there was a lot of different quotes out there where there was over 150 in a single second. You can see right about 1445 as the white line is dropping there, the Dow Jones is dropped. At the same time, the blue, which is ARCA Pacific, the number of quotes has started to go up. So there's high quote volume going on right there. Here's an example of the stocks for the NYSE bid. It was greater than the national best bid or best offer price. That's the number of stocks. You see that green spike right there. That's because they were lagging. Their systems were behind the rest of the market. The ask price was below the best bid price as well. This is the number of stocks. As you can see, it spiked up around 190 stocks as the market was falling down. This is the NYSE reports that the trades below the national best bid, consecutive NYSE trades, so that's in a row. There's a big spike at 1445 as the Dow is falling down, but not at its peak. Here's an example of Coke. So the two lines here is the lag between the NYSE and the NASDAQ, and then also the ARCA prices. So the green is NYSE, the light blue is ARCA Pacific, and then the other blue is NASDAQ. As you can see, the Pacific, ARCA, and NASDAQ started falling first, but NYSE was lagging. So firms that noticed that knew that it was going down ahead of the NYSE quotes, so they could buy on the one exchange, sell it on NYSE, or even short it. Here's another chart showing the difference between the CQS versus the NYSE open book delay. You can see in the middle that that was up to 400 milliseconds differences. So Nanex came up with a feed saturation ratio, and this shows not only the flash crash, but then also up to 2010, up from 2009 through 2010. And you can see right before that big spike in the middle, that's right before the flash crash. The SEC did a number of analysis on it. It took them, initially I think it said about 5 months, but now they're saying about 3 months to compile all the data and then run a report on what they think was the cause. They pointed the finger that it was a sell algorithm by what they call the fundamental trader to sell 75,000 E-mini contracts. Well, Nanex actually looked at the data from the fundamental trader, and they compared it to what actually occurred during that time. The majority of the trades by that firm were executed when the market was going up. So you can see where they sell the fewest number of contracts was the point when at the bottom point of what the flash crash was at that time. When the market was recovering and going back up is when they actually sold more of the contracts. So we didn't see that this really made sense to point the finger at this one firm for their sell algorithm when it wasn't pushing the market down. Well, we really noticed a lot over the analysis that there is a lot of quote messages out there. The number of trades to quotes has decreased. Trades have gone down, whereas the quotes has gone up. Why do people do this? Does it add value putting more bid-ask quotes out there? The exchanges were transmitting hundreds or even thousands of quotes in 1 second for a single stock. We saw examples of 3, 4, even 5,000 quotes in 1 single second for one stock. And at times, the quote was the exact same price and size. It was just repeated over and over and over again. So it was not adding any value. It was not improving the BBO at the time. And a lot of times, the quotes were even way outside the BBO. For example, if a stock was trading at $5, you might get a bid at $2 and an ask at 10. So it's way outside the NBBO, so it's not improving, no value, it's just noise. And this was a term that Eric came up with called quote stuffing. Why do people do quote stuffing? Well, it can cause dislocation. It can add another opportunity to cause other systems to slow down. And then the firms that do that look for different arbitrage opportunities. Can they buy on one exchange and sell on another? Can they trade the E-minis versus the SPY based on that? And it can confuse the different algorithms out there. People spend a lot of time and money building different algorithms out there. They're looking for different ways to game the system and get an advantage off other people. One of the ways that people have combat this is with quote stuffing. They'll put different quotes out there to confuse smart order routers, to confuse other algorithms, to get an advantage. There's what some people refer to as exchange gateway latencies. They will look at the speed that they can get an order executed on one exchange versus the speed at another. And then they will look for that difference. So if it takes them 2 milliseconds to get executed on one exchange and 3 milliseconds on another exchange, then they will know that, and they will be checking that throughout the day because it won't be consistent. So they'll be sending out quotes to see what the latency is from, say, ARCA versus NASDAQ or BATS.
Hey, Jerry, I've got
send orders based on that.
I've got a question.
The gateway latency. Yeah.
Sorry about that. I have a question for you, Jerry.
Sure.
Do you find quote stuffing, I mean, is this pretty much just happening on equities? Because what about the exchange messaging limits? You know, does that apply to futures only, or is that for equities too?
Well, when an order is sent to the market center, they have different ports, and there's a limit that they can send on that port. But then what some of the firms will do is just have multiple ports, so they can blast out those quotes to that.
So isn't there? This is outside of my realm of expertise, but I thought that there was some type of a messaging limit that said for every X number of quotes that you transmit, you have to execute one order. You know, you have to get filled.
Yeah, that's fairly new. It doesn't stop you, but it's just a fee that they're starting to charge. And I'll go over that. ICE is doing that. NASDAQ's going to be rolling that out here shortly. So they've got different ratios from the traded quote ratios, but that doesn't apply for everybody on all exchanges.
So, I mean, is that specifically trying to target the quote stuffing? I'm wondering. Well, first of all, can you clarify for me? Is quote stuffing happening with futures, or is it pretty much just equities?
No, across the board.
Okay. And did these new messaging
especially
limits,
on the options markets too? Yeah.
Okay. And do these new messaging limits apply to everything, or is it just futures?
It's an exchange by exchange level basis. Okay.
So you said that there's just a fee. Do you happen to know, I mean, is this fee a real deterrent to stop, or is this like a, whatever, that's not really, okay.
No, it's not. In fact, depending on which exchange, some of them even have waivers for some firms.
Oh, okay. Well, that must be nice.
So it doesn't, it doesn't even apply to everybody.
And speaking of these golden firms, the original report by the SEC on the flash crash, right? I mean, they know who that 75,000 contract order came from because they could see that extra bit of data that, of course, no one else can see. But did they ever release that information? Was it ever made public?
It was not officially, but we've talked to the firm who it was, and that's how we got their trade information on that graph earlier that showed that.
Oh, okay.
That's how we knew that their trades were. And in fact, they ran the same order on different days, and it did not cause a flash crash.
So basically, the SEC was completely wrong, and they're just not willing to admit it. Or is it possible, or is it practical that, or probable, I mean, that they really have no idea what happened?
Well, there was a lot of moving pieces and a lot of data, and they were under pressure to point the finger at somebody.
Right. But, I mean, without actually, I'm just, we have all these limits, right, of how much the market can move up or down. Is that really the only safeguard that there is? Is that this has happened since May 2010. It happened several months ago in crude. There was some rogue algo that sent crude, off a cliff, and they halted trading for a little bit. Is that pretty much the only thing we can count on these days, is to halt trading?
Yeah, that has worked quite a bit. In fact, even on the flash crash when the CME halted trading, that caused people to take a step back, look at things, and then the market was more orderly and it recovered at that point. And that's one of the things that the equity markets are starting to do now too, is they'll do that pause where it seemed to work pretty good on the CME and then NYMEX as well too on that crude oil.
Okay, and I see Eric saying he's got a story. So Eric, if you want, your mic is on.
Well, I don't want to take up too much time, but we were kind of in the middle of the whole analysis of Waddell and Reed and what the SEC knew and what they didn't know and what they wanted to share and what they didn't want to share. Waddell and Reed gave us all their trade executions, which was approximately 6,500 or so executions that made up 75,000 contracts. And as Jerry mentioned, that is how the plot of data comes from. Their actual trade executions. We matched them up to the CME time and sales from our data set, matched time, price, and size. They all matched up perfectly. And one of the first things we found is all the trades were executed at the offer. So it never crossed the bid-ask spread. It never actually hit the bid side, which was quite surprising because if you read the SEC report, it's pretty clear that their algorithm is supposedly aggressive, but selling at the offer side is not aggressive.
Right. So how it can't move it down, right?
You can't push a market down by sitting on the offer side. If nobody ever hit the bid, they would have never been able to sell all their contracts at the end of the day. What was most fascinating about the whole event was Waddell & Reed uses Barclays to execute the algorithm. Waddell & Reed is mostly a mutual fund, and one of the funds that sold these contracts did it to kind of boost their returns by a few percentage points. They don't actively trade the E-minis. They just used it to hedge against their position. So they used Barclays, and they've used them in the past to do this, and they're well aware of the different algorithms and the impact on the market. And so Barclays executed the contracts for Waddell & Reed, and it was actually led by a man there at Barclays named DJ Pan. Talking to them after we analyzed and charted a lot of their trades out, I said, so I don't understand how the SEC, when you talk to the SEC about the algorithm, how could they not see that it was passive? And the shocking reply was, well, they never interviewed us. And that was astounding because they finally got around to interviewing the Barclays team that executed the contracts, blamed for the flash crash, 2 weeks after the SEC released a report on October 1st. In fact, you can go and probably still Google CFTC DJ Pants, and you'll see that afternoon there was a meeting between the two, and I confirmed with them that was the first time they ever met. Waddell & Reed has sent several Freedom of Information requests for details on that meeting because it would prove this, and they all but denied. So
yeah, well,
I'll just leave it at that. That's
all we have to do is look at what happened, yesterday with PFG to figure out that regulation's a joke. But anyway, that's a little off topic.
It's one thing to be a joke or bureaucratic. It's a whole other thing to like a homicide detective, not actually, interviewing the suspect ever.
Yeah, that might be important. All right, thanks, Eric. I'm going to leave your mic on, but I think that you can mute it on your side and just pop in if you have something else.
Okay.
Thanks, Jerry.
Okay. One of the other reasons why people do quote stuffing is it confuses people. The audit trail is more difficult to follow. Like we said, the SEC and CFTC going through all of this information took them months to go through, and this is only one day. So they're looking to build a consolidated audit trail system now. It's forecast, I think it costs $4 to $5 billion to build and $2 billion to run on an annual basis. They just voted today to scale that back from real time. They'll only be looking at it on an end-of-day basis next day. So it's a lot of information. That's why people just keep blasting information out there to try and hide it. So the markets send the data and more than one symbol per channel. For example, OPRA sends the data on 48 channels. NASDAQ has 6 channels. ARCA has, I believe, 48 now. And these are all in alphabetical order. So what a quote stuffing will do, you can blast out information for one symbol, and that will affect the latency for other symbols in that same channel. So if you're looking at looking for something to affect Google, you can send out another quote stuff another symbol with G in it and affect the latency for Google. Jeff plotted a lot of these quote stuffing examples, and he would put out what he called a crop circle today. And a lot of these plotted different things. This is one he called a knife because it goes out that way. As you can see, the red line on the top is the ask price, just oscillating back and forth. Whereas in the middle 2 lines are the BBO. So you can see it's away from the BBO and it's not adding in any value at all.
So this actually raises a really good point. So is there any, are you aware of any regulation from the exchanges that would limit this type of stuffing that's that far away from the best bid? I mean, why? It's clear. The tactic is clear, so you would think that the exchange should be able to limit this if it was in their best interest. Maybe it's not. Maybe they, don't want to do it.
Well, on an exchange-by-exchange basis, they have started limiting it, and we have seen significant changes since December. Unfortunately, we have 10 different exchanges, actually 11 and 12 in some cases, and each exchange's limit might look somewhat reasonable, like NYSE is targeting around 300 per second. But if you had 300 per second per exchange, now all of a sudden you back up in the 1,000 range. And in fact, this is exactly the behavior that we've seen change over the last few months, where it used to be a large number of quotes coming from one exchange and one symbol. This is now spread amongst 5 or 6 exchanges at a lower rate, all lower than the exchange's threshold, but in aggregate, way too high for more than a few dozen symbols to to occur at any one given point without overloading the entire system.
Right. So they're basically just gaming the system, and it's getting worse.
Yeah, they're clearly doing it for a reason. It's not a stupidity anymore. We've talked to I've talked to programmers at the different exchanges. I've talked to board of directors. I've talked to angry high-frequency traders. I've talked to lots of people, and we're pretty sure it's not stupidity anymore. Like, I think the message has gotten out, and yet it continues, and it continues to morph and get around any limitations put in its way. And some groups are exempt from the limitations. For example, options has a cancellation fee, and except they exempted the market makers, and lo and behold, this is the exact group that's causing high quote rates. In fact, one of my customers calculated that if Philadelphia was subject to this, their bill would have exceeded $30 million in one day. We don't think they're paying that cancellation fee.
Right. So, Jerry, sorry to interrupt the flow of your presentation.
Oh, yeah, no problem.
But I've got a question. So, the people that are on this webinar, okay, not too many people here are running hedge funds or are institutions. We're talking normal retail traders. Some of them are just regular investors. How can we be expected to compete? This is getting worse. This is going to happen more and more often. We're going to see these mini flash crashes that are going to halt markets. But then just in general, I'm just talking HFT in general, on the tactics that they're using in order to make fractions of a penny on stocks or a tick or whatever. How can you, as a regular retail trader, compete with these guys? Are you finding it more and more difficult, or do you think that it's safe that a regular retail trader can kind of just discard what's happening with HFT? Does it not really directly affect them?
It does affect them. One of the things you just got to be aware that it's out there. You're not. I mean, before you were able to scalp off quite a bit. Now the HFTs that are co-located and they've got a 1,000-foot cross connect away, they're going to have an advantage against a retail trader. So don't expect to me making the quick scalps that you used to be able to. The trades are going to probably be a little longer term now than they were before. And a lot of people are going to be stepping in front of you. So you might see an order out there now and you might get a trigger and then you don't get filled.
But
because that other firm was faster.
Yeah, but what I'm wondering is I've seen with greater and greater frequency traders kind of blaming HFT, and they're blaming it for erratic market behavior. I'm not talking about one tick. I'm talking about just moves that don't make sense overall throughout the day. And I'm wondering, or I see a common thing is, it's because of the HFTs that my stop got hit. I don't really subscribe to that. I'm wondering, what do you think? Do you think that there's merit in that? Have they really changed the market fundamentally?
The speed of everything has changed because of computers. So the speed of the markets have changed. The internet itself has changed. So everything in the last couple of years has increased the speed that things can get done. Whether that's trading or your signals, everything is faster now. So there's so much hype out there about the HFTs now, that a lot of people are having a very difficult time trading now, so it's easy to point the finger at the HFTs as being the bad person rather than just being a bad market.
Well, that brings up another question, and again, I'm sorry for interrupting your flow here, but the talking heads are always quick to point out on CNBC. Here's something that I've heard at a record pace this year. Quote, volume is drying up, and there is no liquidity. Then you see the split screen argument between the guy on the left and the guy on the right. The guy on the left says HFT provides liquidity. The guy on the right says, no, it doesn't. What's your take?
Both. Eric, you can say a little bit more about that, but the HFTs obviously do add liquidity in there because in the flash crash, when they shut down their systems because they knew something was wrong, that dried up a lot of the liquidity out there. So they absolutely do provide liquidity. But one of the problems is they don't have to stand by their orders like the market makers do or the specialists used to have to on the floor of the New York Stock Exchange. If they see something going wrong, they can just pull out and not do anything. So that liquidity, when it's in there, can also dry up quickly.
The other thing going on is just with Reg NMS and order routing and going from one exchange to 10, for example, used to maybe have 1,000 at the bid, 1,000 size at the bid when you had just one exchange, and now you have 10 exchanges. Well, that didn't multiply your liquidity, it just split it up into 100 shares at each exchange. So now in order to sell 1,000 shares at once, if you want to access that 100 at each one of those 10 exchanges, you've got to send in 10 orders, and the high-frequency traders will see that order appear on one of the exchanges, one of the 10, and they'll just pull their orders back a penny and on the other ones because they know you're coming. And so in that respect, liquidity will vanish immediately, but on an almost imperceptible level. In other words, it's really hard to measure it because it's so small, tiny, and quick. It'll immediately evaporate. One of the other things we noticed when Facebook's IPO came out, right before the open, NASDAQ, looks like they rebooted their systems, and they went completely radio silent for 17 seconds. In other words, there were no trades, no quotes, nothing coming out of NASDAQ in their direct feeds. I mean, NASDAQ completely was out in all stocks.
Yeah, not just Facebook, all stocks.
The second that they came back on, in fact, the first 50 milliseconds that they came back on, the number of orders resting in the order books for SPY, for Apple, for large stocks, immediately evaporated. In other words, the liquidity withdrew that quickly. Like 2/3 to 3/4 of the liquidity just vanished in 50 milliseconds. And in many cases, like in SPY, it never returned the rest of the day. I mean, it was a permanently caused some liquidity providers to just decide we're not going to trade this particular strategy for the rest of the day because this unforeseen outage occurred. And so what that illustrates is that if there's some unforeseen news event that hits on the horizon, the liquidity will withdraw in less than 100 milliseconds, that quickly. So you can have a market that looks nice and stable, go from that to absolutely no liquidity at all in the blink of an eye. And that's hard to measure. And that's why you get the talking heads, you get both sides of the argument, because it depends on how you define it.
Right. It's a very scary situation. Okay, Jerry, I'll try to be quiet and let you keep going.
Oh, no, yeah, that's fine. We get time. Here's another example of an algorithm that's blasting out quotes, and you can just see that it's programmed to make things up. It ramps up, drops down, and you can see on the bottom the green horizontal line. That's the BBL right there. So these quotes have nothing to improve on. Here's more examples of what are called the crop circles. We've talked a lot about flash crash and quote stuff. We now kind of go into what we just started talking, the HFT or high frequency trading. There's a lot of debate on what constitutes HFT. There's not a formal definition as of yet. They're still working on that. But kind of an overview of it's computerized trading strategy used to exploit markets, the inefficiencies of the markets. Trading can be in a wide range of assets, anything from equities, options, ETF, futures, and even more so now lately, a lot of people are doing it on currencies. When you've got those opportunities, they take different trading positions, and they're for very ultra short periods of time. Milliseconds, or now even people are talking microseconds. They've got different systems in there for risk management that people are talking in picoseconds now. But everything gets smaller and smaller. Just a few years ago, we were at seconds and then milliseconds, and now we're down to the microsecond level basis. They're looking for arbitrage between the different exchanges, from one equity exchange or one option exchange to another, or they're looking for different asset classes, maybe comparing the E-mini, which usually leads the market, versus the SPY or different baskets of trades or the leveraged ETFs. So they'll try, if they're looking at the E-mini and then they know, all right, SPY is going to be following this either up or down, then they might take a position real quick on one of the leveraged ETFs. Latency is extremely important. Most people think of latency as transport time, but there's also not only time from the exchange to you, but for your system to process it, for your system to make a trading decision, and then after it's made that decision to route that order back to the exchange. Each exchange has its own latency, so it's not the same for every single order, every single message that you receive. Some of the effects of HFT, we talked about the quote stuffing. They can blast out a large number of quotes that don't improve the VBO. They just add extra processing time for other systems to process it. So if you're a firm that knows that you're going to send out 3,000 quotes on a symbol, it's going to go out through the exchange feed. You can ignore it because you know that it's not going to be of any value to you. But the other firms, they don't know that. They're going to be processing that data. All that adds to more processing and adds latency for their trading system. The HFTs also increase the fragmentation of the markets. I'll show you a graph in a little bit here that will show how the size of the trades has decreased considerably over the last few years. You used to have occasionally trades of 10,000, 5,000, maybe even 2,000 shares. Now it's all hundreds because nobody wants to put out a big order out there because the HFTs will see that and know what's going to happen on that order size. But also the fragmentation of the market before, you might have 1,000 shares, go to NASDAQ. Now everybody's splitting that up, sending that to a dark liquidity pool, internally matching it, or sending it to BAS, to Edge,
right,
to ARCA. We're splitting that order up.
So let me ask. I can't be quiet. Sorry. A couple things came up there. So I'm wondering, have you guys ever put together a number that says how many spoofed trades or quote stuffing or whatever versus actual fills? Like, do you have a ratio in mind of just how bad this is?
No.
Okay. So there's no way to actually look and see, you know, it's twice as bad this year as it was last year?
Well, the exchanges are fully aware of this now, and so they have been taking steps to stop that. And then on like ICE, CME, they've put in those different programs, what they call them volume-weighted ratios, to reduce that. So ICE has been doing it for a while, and it's definitely made an improvement on their side. The equity exchanges are monitoring it a lot more now, so if they see somebody blasting out a lot of orders, they will contact them to see what's going on. I mean, I was talking to an exchange just a couple months ago, and they had somebody blast out 30,000 quotes, and they called him up and said, hey, what are you doing? The guy goes, oh, is that wrong? Well, yeah, he can do that. He was just testing the system, and he wasn't aware. So when Eric talked about stupidity before, there was a lot of that out there. And people just had a system that they put out there. They didn't realize exactly what happened to it all the time on the number of quotes. And so a lot of that has been cleaned up because the eyeballs are watching now. Not only the exchange, but the SEC are looking for people that are manipulating the market on that side.
Right. Do you have a section in your PowerPoint to talk about dark pools? If so, I'll hold my question until then.
Not real specific, just broad.
So this is something that's coming up more and more frequently as well, right? And all the extra volume, because it's been increasing pretty dramatically, right? The amount of volume that's happening, off the exchange in a dark pool. So, my next question is it true? Is quote volume drying up? Is this something that is this the new pattern that we want to execute, or institutions want to execute off exchange to bypass all of these pesky regulations, and that's going to be worse and worse for the retail trader that can't do that?
Quotes are not drying up. The number of trades on the exchange, I think NYSE, it was just reported that their executed number of trades, the share volume is down 40% in the last 2 years.
Sorry, so, we had a noise there. In the last 2 years?
Yes.
Okay.
So their trading volume is down considerably.
And over the same period of time, the dark pools are up huge. So is that a coincidence?
Well, they are definitely up, but what's happening a lot of times, and I've seen reports of almost as up as a third are internally matched. So rather than going to an actual exchange like BATS or ARCA or NYSE NASDAQ, they're matching that internally. So depending on who you talk to, that's a good and a bad thing. The exchanges don't like it because they don't get their revenue on it.
Sure.
like Ameritrade, E-Trade, a lot of the retail shops will internally match that. They'll send that to somebody, and then they say they get price improvement. So they'll do a midpoint match between the bid and the ask.
Right.
So they think they're going to get a better price there, and then they don't have to pay the commission to the exchange.
Right. So,
but another thing that's really driving a lot of that too is rebates. A lot of the exchanges now are trying to attract that from the old ECN models that they did back in the 90s and 2000s, that if you add liquidity, you get paid to do that. If you take liquidity out, they charge you. Right. So some people base not only where to route the order on the price, but then they factor in that rebate.
Okay, thanks.
Another thing we've noticed on the E-mini side is that the depth on the book side has decreased. You can't have resting orders in there for a large number of contracts anymore. It's very hard to fill a large size order without clearing out one whole side of the book. Here's an example of a chart for the E-mini depth. The color code, so the purple, which is the highest on the far right, that's up. It used to go up to around 40,000 contracts. And then as you can see back in June, which is the red line on the bottom, it went from 40,000 down to around 5,000. So a trader could go and clear out one side of the book with 5,000 or less contracts, know they're going to move that price considerably, then they might look at the other side of SPY or some of the leverage ETFs on there as well too. Here's another example of the chart. Each one of those lines is a month, and you can see that it's gone down considerably over what it used to be because people are nervous. They're not going to put their orders out there. They don't want the market moving against them. Eric, have you noticed lately, the last few months on the E-mini depth, is it decreased or is it still holding steady?
It's steady. But down. I mean, it's never recovered from
the levels it was 18 months ago.
Right, June 2011, right before we had the crazy days of August last year, which was primarily caused because the amount of orders resting in the E-mini book had decreased so low that somebody who was used to buying and selling 1,000 E-mini contracts would now go through several levels, several ticks, would clear out several ticks immediately, whereas before they wouldn't. That order size was enough that was easily accommodated.
I wanted
so
to
that
ask
adds
you,
some more volatility as you can clear out the side.
What about, and again, I apologize for interrupting, but what about iceberg orders? There's been some debate on the forum lately about how often institutions actually use icebergs. Do you find that this is, it's a little off topic, I apologize, but do you find that this is something that is happening most of the time or not very often in order to hide, someone's true intention? I mean, if it's so easy to move the book around, right, then they have the opposite side of using icebergs. What are your feelings on that? Has it changed over the years?
Well, I think as long as the other side uses fill or kill orders, which don't show up unless there is an execution, then it's fine. The problem is when they're not using fill or kills, they're actually posting new bids or offers that show up at the top of the book and don't hit the iceberg is where we see these. It's kind of hard to explain. I think one of your slides actually has an image here, Jerry. It is pictures worth 1,000 words here. 37. If you just pull up 37. Yeah, you just passed it. 37. There you go. Stop. Okay. So here, the black on the bottom is the best bid. It's walking itself up in pennies, and the same thing is happening on the other side, on the offer side, the red coming down, and those are supposedly are looking for for these iceberg orders. They shouldn't actually, if they were, whoever was doing this was using fill or kill orders, it would never post unless a trade executed. So I'm not sure why they're not using fill or kill. It might have some, I'm sure it has something to do with the rebates.
Okay, thanks.
Yeah, it just walks up, drops down, walks back up, drops down.
Yes, this is becoming a lot more prevalent. And right here we have two exchanges interacting. The black is NASDAQ and the red is ARCA. We now see, as the exchanges implement their own limitations, and the response to that is to, well, we won't do 1,000 at one exchange, we'll do 300 at 3 exchanges. We now see like five or six exchanges participate in this, where it's obvious it's the same person behind it. Instead of reactive, you'll see, instead of seeing two colors here, you'll see multicolors, and it's very fascinating to see the patterns that evolve. It doesn't make a whole lot of economic sense.
Right. Thanks, Eric.
Yeah, Eric, you want to talk about the crude oil algo, and Mike touched on it a little bit ago. There's been a couple of situations the last year or so when crude's had some issues and they've had things cleared out and they've actually paused. One of them was on July 7th of last year. The August contract cleared out both sides of the depth 4 times in 5 seconds, just flushed it all the way out. And then there was also interesting moves on the ETFs like USO and then the leveraged ones also right at the same time. So it's clearly algo-based trading that caused that.
Right. To us, it looks like there's these always involve multiple instruments, ETFs, and then also stocks like ExxonMobil, and then a lot of the options underneath those other instruments. And we believe it all involves a strategy where you enter the position when activity is light and spreads are tight, and you exit your position overall when the opposite is true, when you've caused a lot of, it was an expression, you banged the beehive, and people are reactive and spreads are not so tight anymore, and that's when you exit your position. And there's a lot of evidence to support that where people are just buying and selling large numbers of contracts that completely clear out the order books in crude or in the E-mini, for example, and you get the simultaneous reaction in the ETFs and the options and everything else, which causes a mass amount of data.
So quotes, also it happens in the options market. There was 9 now that just NASDAQ added the 10th exchange. They quote over 500,000 contracts. Each one of those exchanges provides a bid-ask price and size. So in this extremely large amount of information that they blast out. Right now they're doing over 3 million. They're forecast to increase up to 10 million messages a second. Just to receive and process the data, you need over 2 gig of a telco line just to receive the data. It's broadcast in 48 different multicast channels, so you've got to process all of those in parallel, bring them together to do the analysis. Every day there are new contracts that are out there that have over 100, 200, 500 quotes per second, and none of those quotes really improve the VBO. A lot of them are just size flickering back and forth, but once again, that causes somebody else to process that data and slow them down. Right now, Apple is split because there's so much, the stock has moved so much. It's its own channel. SPY is its own channel too. Before, when they were in another group, people could blast out quotes on another symbol that started with A to try and slow down the options on Apple. Many quotes are sent just to add latency is all that they're doing. Yes?
Actually, Apple's on 2 channels now.
Yeah, they split the bid and the ask.
Yeah, the calls are on one, and no, it's calls on one, and the puts are on the other.
Puts and calls, yeah.
Right, so Gold, SPY, and Apple each have 2 multicast dedicated channels, and that's still not enough.
One exchange that seems to be doing quite a bit of the quote stuffing is Philly. You can see, here's an example. The blue line on the top is the Philly exchange, and then ARCA and all the other options exchanges in there. Right there, they were 40% of the option quotes, the one exchange, but there's 9 exchanges out there. And the majority of those quotes are so far outside the BBO, they don't add any value to it at all.
I'm sensing a pattern.
Yeah. With OPRA, even though it is a lot of data right now, their capacity is increased, but still there are times when OPRA looks like it gets saturated because it flatlines right up across the top as that black line shows. And as soon as they add new capacity, boom, it jumps right back up to that capacity again. So the exchanges are processing a lot of information. They will have issues with the latencies. We talked about how the number of trades on the exchanges have gone down, but the reverse is what's happened with the quotes. With quote stuffing and the number of exchanges added, just a few years ago, you didn't have BATS, 2 BATS exchanges, 2 edge exchanges. Now NASDAQ's got the Boston exchange, the Price PSX exchange, ARCA. So there's more and more exchanges out there. Each of those want to get to the NBBO, and they're putting more quotes out there. So as time's gone on, the number of quotes has gone up, as you can see to the right, but the average trade side has gone down. So not only the number of trades, but then the average size of the trade has considerably gone down now.
One thing I like to mention is back in the 1999 internet bubble mania, crazy stock market, crazy bull market, the NYSE had a system capacity of sending 1,000 quotes per second. Today, it is 1.4 million per second, and we don't have the crazy wild bull market we did back in 1999.
And things are quoted in eighths. Here's the quote-to-trade ratio. As the number of quotes has gone up, trades gone down, that ratio has gone up considerably. You talked about how can you compete. One of the things is just to be aware what happens. And a lot of these algos will kick in right at the open and then right around 10 o'clock. Eric, you want to talk a little bit about this slide here?
Yes, we run into one of the things when you process a lot of data over time is patterns will start to emerge. And one of the benefits of NCORE is that you can go back in time and you can, if you find an anomaly, you can go back in time and see when it started or find out more about it. And really, everything we publish, we use our own product and we use our own tools. So this is really something some of our customers do themselves in other ways. We don't actually actively seek out this kind of behavior. It just shows up either if a customer is asking what's going on here or we're trying to figure out why there's this ballooning extra quote traffic coming from a new group. And one of the things that came out was early on this year, about 80 symbols all of a sudden at 9:45 in the morning went from normal, I guess, quote activity to very high quote activity, and it involved multiple exchanges. And getting back to what I mentioned earlier is what each exchange started clamping down and had their limits, then the response was to, well, we'll just do it on more exchanges but less quotes in each exchange. And this is exactly what went on here. And it's very crystal. So this chart, what you're seeing is a period of the first hour of trading, where you see that where it says HFT off, that vertical line, that's at 9:45 in the morning, 15 minutes into trading. And then at 9:58 is when the behavior radically changes. It looks like something turns off. And then at 10:02, it looks like something turns on again. At the top, you're showing it's the NBBO. It's colored black if the best bid is below the best offer, or yellow if the market's locked, where the best bid equals the best offer in that interval, or red if it's crossed. And that's an indication of some of those algorithms we saw that are just marching up and down, for example, and sometimes actually even cross, or it causes some of the exchanges not to update the quote fast enough and causes a cross market. And it's very obvious when you plot it out that when the quote traffic is not high, you have much more normal. The market is more normal. In other words, it's not as many crossed and locked events versus when whatever is turned on. Now you have lots of crossed and locked events. And this didn't happen in one symbol. This happened in about 80 different symbols, and it started out of the blue on, I think it was January 14th. And what's interesting is that period where it turns off from 9:58 to 10:02. Well, being a software programmer, I immediately recognized that as something. It looked like something new that the programmers were too lazy to build in a table of when news events were released. Many market-moving news releases, economic news releases, occur at 10 o'clock, and they don't want to be in that market at that time because it's a new system, and so the decision was to just, I'm sure the decision was, well, we'll just turn it off 2 minutes before and turn it back on 2 minutes after. And sure enough, after a few weeks of seeing this, it all of a sudden it morphed where there was a week where the economic news report was out on, say, Wednesday and Friday, and we noticed on Wednesday and Friday now were the only times when it shut off. On the other days, it no longer shut off. And you could see it. You could see this, whoever was doing this, you could watch the development get more sophisticated over time. And now, of course, it's hard to see it because it's not such a immediate on, immediate off. Now it's a lot more sophisticated.
Right, and this is one person, this is one institution that's affecting it this way.
Has to be. There's no way this is reactive.
Right, and not just one institution, but probably just one program within that institution.
Yes, and if you see it affects so many, it's color-coded by exchange at the bottom, and you see the multicolors is because it involves multiple exchanges. So this is somebody who's connected to all the different exchanges and is somehow coordinating the updates of these different exchanges. Now, what's fascinating is very little trading is actually occurring in these stocks that are where this is happening. In fact, I don't have the numbers on this one, but I would venture to say that there's probably less than 1,000 trades total in this whole period of time in this one particular contract. Sometimes we see it. Right. We see this behavior going on. There's no trades going on.
So let me ask ETFs. Let me ask just a general question. Why is it that we don't have access to level 3? You know, why is there no transparency? How come we cannot see who's doing this? What's the? I mean, I know why. In the you know, money talks methodology, but is it ever going to happen to where the average person can actually get the transparency to be able to see who's doing this?
Well, I always wonder why I get more information on my $5 order from Amazon about, you know, tracking it, you know, through all the different UPS systems to me, and I don't. If I place a $5,000 stock order, how come I don't know how it was routed or what exchange it was ultimately executed on? I mean, I've tracked down a number of times from my customers who wanted to know why, you know, why their order didn't fill, for example, and it's just amazes me that their broker can't say it got executed on this exchange.
But what about?
And
I mean,
the vagueness involved is.
Can you pick this? Can other institutions or other market makers that have level 3, are they able to use that information to discard this type of stuff, which gives them an advantage? I mean, that's not the reason they were given that capability to begin with. Are they allowed, quote, to use that information to discard this type of behavior? You know, to identify, you know, who's doing it, who's behind it, and then kind of just send that to null.
Yeah. So this is what they live, eat, sleep, breathe, figuring out ways to improve the bottom line. And you bet you would take this into account. Absolutely. I mean, this it's like from a retail trader point of view, just seeing, just picking this up, just avoid these stocks, and it's because it happened. Once you see it, it's just kind of repeats for a period of time. Yes, they take that into account. Absolutely. Yeah, I had the fortune of having dinner recently at Blair Hull. You might have heard his name. He's kind of a legendary trader, and he has an employee named Ham Bodek, who happens to be a key player in a book called Dark Pools by Scott Patterson. Scott Patterson actually set me up to go have dinner with these guys, and they were interviewing a high-frequency trader, and I was able to be sort of a fly on the wall listening to them talk shop about how to improve their it's all about getting at the top of the book and trying to figure out what all these other orders are doing. And it becomes apparent that their input, the input to their systems, are solely, and this is all because of speed, are solely orders that are coming into the system. So these algos essentially are basing their actions on other prices in the system. And those prices are coming from algos that are basing it on yet another level of algos. And there is no economic reality going on here. And so it's fascinating to hear, to listen to them talk for a while, and I finally raised up my hand and I said, just plays devil's advocate here. What would prevent me from trying to fool you into thinking what you're reading is what you think, what you believe? And it was just, it was surreal how, how far removed from economic reality it had become. And in fact, ultimately in the end, it was, I realized that the profits all really come from having access to a dark pool or to retail order flow. The ones, if you don't have access to retail order flow, you're not going to make money as a high-frequency trader. You've got to have a pool of dumb money, so to speak, that you can abuse for pennies per trade.
Right. Well, I've seen.
And there's this whole interview process. I mean, if you want to be HFT and you want to access one of these dark pools, you've got to go through an interview process where they're going to ask you, well, how are you going to trade it? And they're just trying to figure out whether you're smart or not. And the whole game is you've got to pretend that you're not very smart or wise at what's going on here. And again, listening to this, I asked them. I said, so let's say you get access to this pool because you passed the interview. What happens 3 months later when they realize you're not this dumb schmuck?
Right.
And it's just like so surreal. Oh, well, then we'll move on to the next one. Okay.
That actually brings up a good point. Some people say that HFTs don't trade against each other; they only trade against retail. Do you believe that's true?
Absolutely. Look, tell me, why is that 9:20? Why 1 second before the market opens? Is there such a difference between 1 second later? I mean, machines don't sleep.
Right.
Absolutely. You could put them in, if the retail guys decided to boycott it for a day, that would send a very strong message. So you put high-frequency traders in a room, they're not going to generate anything.
Right. So Scott had some articles recently on Zero Hedge that were posted on the forum, and we talked about them. I'm just curious, and he has a new book that just came out, right? Dark Pools.
Yes, that's right.
Do you subscribe to his conclusions or theories in that book? Because I know that it's up for debate. Some people think that it's so far out there that there's just not any truth to it, that this just can't be true.
It is. I listened to them talking about hide not slide and how that will. It's not price time size. So if you put a bid in there and you got ahead, so let's say you put a bid for $80 in there and that's the best, and you got in front of everybody else. If that's a limit order, somebody can take a hide not slide order and jump right in front of you. And
right. That's exactly what he was talking about.
Absolutely.
Yeah. That's what
and
the
I heard them
was.
talking about this. I heard this actual conversation between Hayne Bodek and this high-frequency trader they were interviewing. It was just surreal to hear this, and I'm like,
right.
Wow.
And it was the never lose strategy. It basically never lost. It always just front run and got out.
Right. It's all about being at the top of the book because it becomes riskless essentially.
All right. Thanks, Eric. Jerry, I know you have some more slides, so I'll try to be quiet.
Sure. Yeah, I mean, it comes right in time perfect here. Is it a level playing field? No, it's not. The retail trading firms and small firms don't have the resources that the big Wall Street firms do or the HFTs. To compete on an HFT level basis, you've got to have proximity hosting. You've got to be right at the exchange matching engines. That costs a minimum of $10,000 a month per rack. Most people have several racks in there plus cross connects. And then you've got to have very high-end hardware. People are swapping out their machines 6-12 months at a time. The networks in there now are 40 gigabit networks, so the NIC cards, the routers, switches, everything is very expensive. The programming on FPGA, they're not programming on a software level. So that's expensive to get those developers to be able to do that. And then there's the direct exchange feeds, not only like CME, but also ARCA, BATS, Edge, NASDAQ. They're faster than what the general retail user has, which is the CQS, the consolidated feeds. So you're in milliseconds difference between those feeds alone, let alone the transport time and processing time. And then you also need a team of developers. They're always refining their algos. If you let an algo run for 6 months, that's a long time. You don't build it and let it run, just like any other software. It's an evolution. The firms that are outside of New York and Chicago, big disadvantage because you've got transport time. Speed of light can only travel the data so fast. If you're a West Coast trader or outside of the U.S., that's a big disadvantage. There's been a lot of regulatory changes. The flash crash really pushed a lot of this to the forefront. The Volcker rule, what happened there is they said that Wall Street firms can no longer have proprietary trading. So a lot of those firms have shut down their prop desk. But what happened as a result of that is the firms that used to be on that prop desk are now starting up their own trading firms. So instead of one big firm with 10 traders, now you might have 3 firms with the same guys in there doing similar strategies. So that's adding more data out there, more traffic, more people fighting for that other order out there. One thing that just recently happened at the end of last year, they removed naked access. It's called 15C35. It requires firms to have risk management checks before the order can be routed. Prior to last year, you could have a relationship with a prime broker, and they would let you send your order right in there so that you could get as fast to the matching engine as possible. But now they have to put a risk management check on there. ICE, as we talked a little bit about, they've added what's called a weighted volume ratio. So you can't just blast out a whole bunch of quotes on the Russell 2000 or some of the other options or some of the other futures contracts if you're not going to do any trades. So they've got a formula that looks at the number of quotes that you send, and there's a weighted formula for that. So if the quote is close to the BBO, it's got a factor. If it's farther away from the BBO, it's a bigger factor. And then based on that is what your fees will be for the month. NASDAQ is doing something similar. They're going to have the weighted order to trade ratio. It's similar to ICE, but it's a good step in stopping some of the quote stuffing that we've seen out there. And FINRA's got something called 5210 that prohibits the publication of manipulative or deceptive quotations or transactions, which is exactly what we've seen with quote stuffing. Right. So we'll see if they start enforcing that because now they've got the tools in place.
But the question, I wonder, I look forward to analysis maybe in a few months and you can see if anything's actually changed, because the real question is this a slap on the wrist, or is this a fee? Is this a penalty that's really going to encourage them to or discourage them to continue this behavior?
The fee, well, like I said, some of the firms are exempt from the fee. Some of the market makers are, so it doesn't apply to them.
Oh, yeah, of course.
But it's, yeah.
So it's just like, we see time and time again where someone will basically knowingly violate the rules, and then the fine is, a fraction of what they actually profited.
Right.
Yep.
Because they're funneling the business to the exchanges. One thing that's interesting to note, though, is that the HFT profits have decreased. So the TAB group recently came out with what they estimated to be the profits. 2009 is the markets were recovering from 2008. It was estimated that they made $7.2 billion, whereas this year it's expected to only be $1.8 billion. So you can be optimistic saying that they're not making as much money, and hopefully that you guys on this forum are making some of that money back. And part of that is to compete now, it's extremely expensive. It's an arms race, so they've got to not only get new hardware, you've got to have the best hardware in place, the best developers, and those cost a lot of money. So the costs to get into that are increasing, and as the spreads get smaller and smaller and the ability to make the money decrease, a lot of these firms are just saying, I can't compete. And so they've got to change their strategy from not just HFT to maybe a longer-term trade or some different algos out there. On pure speed, a lot of those firms just can't compete.
That's a really fantastic number, and you have to split that across countless institutions. So that's eye-opening. I didn't realize that. I'm wondering. I want to find that report. Maybe you can send me a link after, and I'll post it in the thread.
The one from the TAB group?
Yeah.
Sure.
Thanks.
I think it came out late May. Yeah, I'll find it for you.
Okay.
And now we'll open up the questions.
Oh, great. Okay, let me start by trying to go back and find some questions from members here so they can get their questions answered. Michael wants to know, are there any particular markets that would be good? Are there like targeted markets that you could say this will avoid HFT? Grains, hard, soft. Is there any kind of is there anything that's really exempt? Is there anything safe?
The futures the futures have a lot less issues than equities. In fact, I think the CME does a pretty good job overall.
I think a lot of that's because you can't fragment the market. It's a single market center for that.
Exactly. Yes.
Trade.
Yes. ETFs are a big problem. They live in ETFs. A lot of what goes on, this kind of crazy behavior, it's not exclusive to ETFs, but it's a high prevalence.
And what's your opinion on the underlyings that, affect the SPY and then how the SPY interacts with ES? Is it, even though you're saying the CME, ES is safer, isn't there I don't know what word I'm looking for. There's a link, right? Is it still going to be affected because of what's happening?
Absolutely. Yeah, absolutely. And one really simple indicator is the size in the depth of book on the E-mini. If there's plenty of size, like 10,000 contracts or more, which is pretty typical at the end, the last 15 minutes of the day is always very solid. Just monitoring that and getting out of the way whenever it drops off, or just changing your strategy will go a long way. There's less impact on SPY and all the other derivatives when there's a lot of size, because it takes a lot of contracts to move the E-mini more than one tick. If you
Right.
see how much it can move, let's say 2,000 contracts, and it's only going to move at one tick, well, then you're not going to get that much of a reaction.
Right. Okay, so a couple things. First of all, don't forget that we're going to give away 3 IQFeed subscriptions here in a few minutes, so don't leave just yet. Go ahead and start typing in your questions if you guys have questions for Jerry or Eric, and I'm going to go back and find some questions that were posted during the presentation. Dennis asks, he says that you reference match at midpoint type orders in the book Dark Pools, which we talked about. There's section on how the exchanges have special orders which give them a beneficial place in the market, allowing the exchange biggest customers to take advantage. I think we talked about this briefly, but is there anything else you want to add?
Well, at that dinner, one of the conversations was how GetCo had become so powerful. It pretty much instructed a few new order types that they wanted, and they were accommodated.
Right, and that, I guess that shouldn't really surprise anybody.
It should surprise everybody.
Well, I mean, it should, but it's like commonplace, though. It's like, yeah. Anyway, I don't want to go too off topic.
It reminds me a little bit of, you hear the stories of like the NFL teams, how, the star athletes, they get to slide a little bit on checking in and things like that. It's kind of like that. The big firms, they get a lot more say, and they get more leniency on a lot of those things. So,
right.
So here's a lot more order flow to the exchange. They influence it more.
I see a couple of questions that I'll kind of combine into one. So let's say that I'm not a hedge fund, I'm not an institution, I'm not a market maker. I'm just Bob, and I would like to earn a living trading futures or maybe ETFs or whatever. So now that I have all this information on what's stacked against me as with HFT, what should I do? Is there anything that I should do? What would your advice be to the regular retail trader? Aside from just simply know what's out there, is there any specific actions that somebody can take to improve their bottom line?
Increase your time frame.
Okay, I love that one. I am in complete agreement. So the rationale behind that is, HFT is on a very small time frame. The further you get from that, the better off that you'll be.
Yes.
Okay. And Eric, I actually had a question that I wanted to ask you. Do you trade? I don't know this of you.
No.
Okay.
I'm not a trader. I got started trading, and I prefer being a programmer, but it's also a little bit of a conflict of interest with some of my customers.
Well, let me ask you a hypothetical.
I want to make sure that I don't trade.
Yeah, I can understand. Let me ask you a hypothetical. If you were to trade, would you be a discretionary trader or would you be an algorithmic trader?
Well, I guess I do trade, but my trades tend to be very long-term. Like, I think the last major trade I made was buying Apple back in 2000. So it's real long-term.
Right.
Kind of thing.
So you're an investor.
Yes, and I would never use a stop order. Never.
Okay.
Hopefully I was diversified enough where one stock cratering to zero wasn't going to take me out.
And Jerry, I want to ask the same question of you, but before I do, so that's an interesting point about stop orders. Let me ask both of you just in general about what is commonly referred to as stop hunting. Is it more myth? Is it true? I mean, aside from just the basic common sense stuff of, let me put my stop, a few ticks below a recent swing low. Aside from that, is there actually a program out there that will use the level 3, the full book to its advantage and actually seek out stops even at levels that, you would say are supposed to be safe, that don't make a stupid mistake like being too near a day, high or low or a swing low or high? Does that exist, or is that really not? Is that more of an excuse?
I think it exists on some level, but really what's going on here is the way Reg NMS is set up. It only protects the top of the book at each exchange. So let's say all the exchanges are bidding. Say there's 10 exchanges, and they're all bidding $80 for this one stock, and it's all 100 shares at each one, and somebody wants to sell 5,000 shares. Well, that will clear out all the $80 at the other exchanges. And Reg NMS allows the balance of that order to execute at that local exchange regardless of what the price is on. So if somebody has a market order in there, it could, by regulation, go down $10 from that point. Even though another exchange is best, let's say the next highest bid on the other exchanges is $79.99, but on this local exchange it happens to be $70. Reg NMS allows the balance of those trades to execute locally. They do not have to route it, and that absolutely occurs, and that's where you see a lot of these many flash crashes occur. In fact, sometimes it's interesting, they'll occur in a group of symbols all at the same time. It's almost like there's a fund manager out there that didn't get the memo by not using market orders,
right.
and who used to think nothing of being able to sell a few thousand shares, and now all of a sudden that clears off the top of the book, right, and exposes that market order to much lower prices.
So Jerry, what about you? Do you trade?
No, I don't have enough time.
And same question, if you did trade, would you be a discretionary trader or would you be an algorithmic trader?
Discretionary.
Okay. And do you agree with what Eric said about the time frame, or do you have any other thoughts?
Yeah, absolutely. Yeah, I would definitely say increase your time frame to think you're going to be in and out in seconds when you're competing against people who are looking at microseconds.
Right.
It's very difficult.
So scalping is the hardest thing to do.
Right. But I mean, there's people that make it. We've got customers that are overseas, and it's working for them, and so they've got considerable latency. So.
Right. Okay, so here's a question from Mike. Does HFT increase the, I'm trying to rephrase, let's say that there's patterns in the market that some people swear by, like Head and Shoulders, for example. Do you think that HFT has anything to do with turning those patterns into like a self-fulfilling prophecy? Do they look at them? Are they aware of them? Do they totally disregard them?
If it's a price that can be put into a table before trading, so your software doesn't have to go look it up or costing time, you betcha. I mean, that's just easy programming that costs no time at all. Absolutely, they would be aware of those things. It would be something they would set up pretty open.
Like all Fibonacci numbers or something.
Okay, right. That's a good example. So, okay, so a lot of people again will say HFTs are like they'll purposely look for a common signal that people might trade. Like the 200-day moving average crossing the 50, or maybe the MACD or whatever. Do you believe to that? Do you subscribe to that? That these traders are really looking at that? Because I'm not sure that I really think that that's true. I think that they don't go together very well. HFT is all about.
The eyeball traders are.
Well, it's not like they're going to game it, but when you get around to that level, they may widen their quote by a penny. It's not going to be something you detected, but it's just on balance. It makes sense to respect that widely followed indicator.
So I think it's important to remember that there's more kinds of algorithmic trading than just HFT, and it seems a lot of people kind of forget that,
Yeah, there's a huge difference. Absolutely. I mean, we've talked to algorithmic firms that are pension funds, firms that like John Deere, Caterpillar, firms like that have pension funds that they're managing. They've got algorithms and quantitative groups out there, but they're not an HFT firm.
Right.
I mean, who we talked about the flash crash, Waddell and Reed. It's an algorithm that made that trade, but they're not an HFT.
Do you guys, does Nanex have access to level 3, to the full book?
Yes, we have done analysis on. You're talking about the order books.
Yeah, the full book. More than just 10 levels that we mere mortals get.
Absolutely. Yes, we're still we don't have that integrated into a retail product yet, but we have considerable experience processing it, and we will. Every once in a while, when we really want to drill down to see what occurred, like, for example, in Facebook and NASDAQ, really wanted to see just what the extent of that blackout was.
Right. Do you have any opinion as to whether or not it would be beneficial to the typical retail trader to have more than 10 levels? Are they missing something by not having the full book?
They're missing paying outrageous salaries to programmers. There's a lot of noise in the book, and really it doesn't do you any good unless you're co-located and are trying to trade sub-second. If you're trading above that time frame, it's just gonna be an enormous expense. You're not going to get any information out of it because a lot of it is trying to fool the other algos into doing whatnot.
Right.
I don't think there's a lot of value for
Okay.
somebody trading a little longer term.
Andy wants to know, how feasible is it for the exchanges to add unique channels? Is that something that's a major undertaking? Like you mentioned that Apple and SPY are both, at 2 channels. How would they even go about splitting it up if it's already split the way it is? How could you further diversify that if they needed to?
They just add more. I mean, CQS used to only have 6 lines, and then it increased to 12. OPRA used to have 12, and then it went to 24, and then it went to 48.
But you said like all the puts are 1 channel, so it's not a big deal to segregate the puts across multiple channels? That's not a big deal if they need to?
Well, yeah, big deal is relative. It's usually if the downstream customers have to do any changes, then it's very difficult for them to make that change. It's not just those aggregation at that level. It's the aggregation internal to the exchange. Like one of the things we noticed in the flash crash was there was symbols A through M, except for H through J, had significantly higher delays than the other symbols. And it turns out, after a lot of hem and hawing from NYSE saying there wasn't any issues, they finally came out and said, yeah, we upgraded half of our systems the week before, and the ones that weren't upgraded experienced significantly higher delays. And we said, oh, by the way, was it A through M except for H through J? And sure enough, it was. So how they group symbols on those different computers are not the same. In fact, that information is something highly sought after by high-frequency traders. They have tables of that. They know exactly where what networks are shared by what symbols, and what systems are shared by what symbols.
Right.
And whenever there's a change, they go out of their way to detect it and find out what the new latencies or parameters of that, what's changed, how does that affect order to gateway latency, for example.
So MC makes an observation and asks a question. He says that the ES seems to have cleaner moves overnight, like during the Euro, for example, instead of the U.S. cash session. Have you ever done, or I'm sure you have, do you have thoughts on just trying to bring it back home to how the typical retail trader can best benefit? When trading overnight, obviously there's less liquidity. Why is it that you think that there's less activity on the HFT side? Is it simply because there's less retail traders out there, so they can't take advantage of them?
Yes, exactly.
Okay, so it's my feeling, and I think that analysis backs this up, that we typically see some pretty big moves overnight. In fact, there was a report out not too long ago that said, there's the typical buy at the open and close or sell at the close strategy. If you reversed it and bought at the close and sold at the open, you would do many, many times better over the years. So saying that, the market tends to move in more of a straight line overnight. Do you agree? Do you have any analysis that would say that's true or false?
I don't, no.
Okay.
I think there's a big difference between, that's more of a longer term move relative to HFT. HFT really exists and impacts the market on a very, very short-term basis.
It's more of a swing trade.
Yeah, right. Very like in seconds it's going to affect it.
Right.
And that can sometimes amplify and cause even larger problems.
Right. I'm just picking your brain in general while I have you here.
I have never done that. It might be interesting to run that.
Okay. I hope you do. I love your reports, by the way. Okay, so let me find some more questions here. Paul wants to know, he says that it appears most of the HFT strategies are designed to exploit retail. Okay, I think we've covered that. So he asks, is there a large, or if there is a large spike in volume, could it be assumed that most of that traded volume is from retail getting stopped out? Is there a way to know, if it was retail, like, I think what he's describing is, let's say crude moves down and takes out a bunch of stops and then immediately reverses the other direction. Do you have any way, have you ever come up with anything to try to identify that type of a pattern?
Yes, definitely. When what you'll see is if it's a large stop for retail wanting to push or having to get in versus an algorithm, you're going to see successively higher or lower prices. On the equity side, you'll see every single next trade is successively higher than the previous one or lower in one specific direction, all at that one exchange. Futures, it's a little, well, even so for futures, like when we see big moves in the E-mini, you typically will see all the ticks in the same direction until it reverses itself. And those generally, if you add up the number of contracts involved in that, they tend to come out to very round numbers, like 1,000 contracts. Exactly.
Right.
So then you know.
Yeah. So
that's quite common in the E-mini. If you do that, if you look at ticks in the same direction, you'll see it'll add up to exact nice round numbers like that.
So I apologize for going a little bit off topic, but are either of you guys aware of what's commonly dubbed as cumulative delta volume? It's basically a way of looking at whether or not an order was whether or not it was a market order versus a limit order, and trying to determine that by where it was executed.
I've heard people, but I have no personal experience with it.
Well,
for futures, you're just talking about whether to match the trade up to the bid or offer?
Well, yes, and there's some analysis. There's multiple platforms out there that track what they call cumulative delta, and it's basically whether or not they're trying to determine if it was a market order or a limit order. We only know if it went off, at the best bid or ask, right? And we assume it was a market order, which is still a lot to assume, but they try to track, and it's kind of the people that subscribe to this methodology believe that it gives them some insight into the true intentions. And I'm wondering, do you find, or have you ever done analysis that says that when it really, and again, I apologize going off of HFT, but when an institution wants to actually get into a position, do you believe that they're primarily using limit orders or market orders?
Well, I hope they're using slide, not hide, because they're going to get eaten alive with limit orders or market orders.
And say that again. That's not an order type that I'm familiar with. What is it called?
Hide, not slide. It essentially allows the order to stay hidden until the VBO shifts, and it gives them top priority when it does over a limit order or any other kind of order.
Hide, not slide.
Not slide.
Okay.
Right.
And is that a software side, or is that some kind of a native?
It's exchange speak. It's one of the exchanges offers it, and the other exchanges have different flavors, and they call it something else.
Okay. And that actually goes to the next question. Bill wants to know, why does the CME still permit iceberg orders if it's a form of manipulation? Now, there was some recent talk about this as to whether or not the CME natively supports an iceberg order type, where it hides the true size. And I know that a lot of platforms support it. What do you think?
I just don't see a problem with somebody having an order in there that they actually want to execute on versus because it's impossible to fool anybody because nobody's going to be.
Yeah.
You're hiding your intentions. You're not giving them false intentions. Big difference.
And for my own curiosity, so hide not slide compared to like fill or kill. Give me the quick. School me.
Well, fill or kill just means if it's a limit order, that means I want to buy it at this price at a limit, but if you can't fill it right away, in other words, there's not an existing executable order, then kill it. It doesn't even show up.
Right.
Yeah, it doesn't even go out the feed, so you won't even see it in your system.
So you can't really manipulate anybody else by that. It's purely a mechanism to want to buy without showing your hand. And again, I think that's
sure.
I don't see anything wrong with it. That's not.
So I'm pretty familiar. Yeah, I'm pretty familiar with that, but I'm not familiar with the hide not slide. So I'm just trying to better understand what exactly it does.
I wasn't either until that infamous dinner, and that's when I learned more about it.
Is it like an iceberg order where you're basically hiding the size?
Well, they're all trying to get to the top of the book as soon as it flips from one price to another. So when the whole bid ask ticks up or down, they want to be at the top in that direction of the book. because that's the best place to be. You don't, when the market's shifting up by a penny, you don't want to be on the offer side right before it shifts.
Right.
Because, well, for obvious reasons, you want to be on the other side right when it shifts, and the hide not slide gives them the ability to do that.
That's man, I'm gonna have to do some research because that just that seems unreal. Is this something that's only available to market makers, or can anybody use that order type?
I think you have to have sponsored access.
Okay. That figures. All right, so Scott asks a question. He says that there's an algo on RBC named Thor. He wants to know.
Oh, yes.
Okay, you're familiar. All right, he says, is it having any effect on HFT? So I don't know about it.
That Thor was a while back. Yeah, so my example when I gave out earlier, when you want to try to sell 1,000 shares and you've got 10 exchanges and each one has 100 shares out there, well, Thor meant to solve the problem of if I send 10 orders to all the exchanges and one exchange executes a lot faster than the others, the high-frequency traders will see that execution and they'll withdraw their orders by just back off a penny on the other exchanges because they don't want to, again, they don't want to be on the edge when the bid and offers slide one direction or another. So what Thor purported to do was it would measure the amount of time. Let's say the BATS exchange would receive the order to the point where it was displayed where everybody else saw it. Let's say BATS took 3 milliseconds, and let's say NASDAQ took 10 milliseconds. Well, the strategy is we'll delay the order 7 more milliseconds to BATS so that it will show up at the exact same moment on all 10 exchanges. Nobody's going to get in front of us or see us and withdraw.
Okay.
Well, that was something that was in place a couple of years ago. Well, the counter strategy to that is that BATS has a 3 millisecond interval between receiving an order and displaying it only if the system is running perfectly. If it has to process another 5,000 symbols, well, now that went from 3 milliseconds to 5 milliseconds. If it has to process another 20,000 symbols or quotes in a symbol in the same group, it's now 7 milliseconds. So by randomly jamming the exchanges with quotes, you've now disabled Thor. Not always, but you've increased the number of times that you will see that order before it's able to execute on all the exchanges simultaneously.
Okay. Julia says, if Nanex is kind of crusading against HFT, I'm not sure that that's accurate, but I'll ask you, why? I mean, this is your business, right? So, are you? What is your position?
We're not against HFT. We're against this secrecy, this not routing based on the NVDO, which to us is really the crux of all this. When you end up processing a billion quotes in a day, and you realize that those quotes are they're not routing based on the NVDO, which puts our customers at a disadvantage.
Right.
Nobody's going to sell software to HFTs anymore. It's all custom. It's all they're not going to waste a single execution cycle or CPU cycle on doing anything but getting an order to the exchange.
Right. Yeah, I think there's
no intelligence going on here.
Right.
It's just brute force speed.
Yeah, the fact that they're moving to FPGA that makes it even that really demonstrates that. Art asks the question. He says, "Are orders executed in dark pools? Do they have to be reported back in the official order book? Isn't there some type of a time limit or something of how long they can
30
wait?
minutes.
Okay, yeah, so that's real useful.
Well, maybe it's 2 minutes now. Yeah, it's crazy. And here's the other thing going on: the internalizers, when they match orders for all the E-Trade, really all the retail brokers. Those orders get sent to internalizers. And internalizers, their software gives the customer, well, they actually have a choice between giving the customer the SIP or the CQS price or their direct fee price. And I think there's a temptation there, if you will,
right.
to not always.
What does that look like? What does that look like for me as an IQFeed subscriber? How does that order come across? Is it like literally time-stamped back, backwards, or does it show up in real time?
Well, it depends. It can show up late or it can show up in real time. And often what we've seen is that if it's a large order that may impact the market, they tend to always be reported on the latest that they possibly can report them.
Right.
Versus if it's a lot of 100 shares, they might be reported immediately.
Right. And I'm sure
a lot of those are the reporting exchange. You'll see those as like NASDAQ Trade Reporting Facility or NYSE Trade Reporting Facility.
Yeah, there's ways to sleuth those out, to figure out what those are.
Okay. Roger wants to know, just in general, how does HFT function on Forex? So you're talking about an unregulated, uncentralized market. What's your take on that?
Forex is there is no one Forex. It's all different. Depends on who's providing the quotes.
Right. So do you think that there is such a thing as HFT on Forex, or is it just not possible because it's so
well, it's always possible with a speed advantage. Just being able to without knowing what's going on under the hood, and given the temptation and the monster that Wall Street has created here,
yeah.
that Scott Patterson, briefly pulled the covers off of. I can't imagine that there aren't similarities going on there.
Yeah, I hear a lot more people within the last 6-12 months starting to get more into HFT and Forex because it is a fragmented market, which you need like on the equity. So you've got different places to execute orders,
right.
And it's worldwide.
It's
24 hours.
Yeah, I could see basically the advantage of just spreading across multiple, liquidity banks. This is the speed advantage, right?
Yeah, and you can get, a couple pips spread from one execution venue to another one.
Right. Ben asks, is there anything that a retail trader, let's say that I have my own algorithmic strategy that's, as sophisticated as a retail guy can normally make it. Is there something that I can do? Can I send out 1 million quotes? Is it really going to make any difference? Are the institutions going to care?
It won't make any difference, and your broker will tell you to knock it off.
Right.
One thing that I might not have mentioned, and I've seen a positive response. One of my customers is just is relentless at tracking down when he gets a bad fill or something's doesn't match up. If you're relentless like that, and you're getting, like, say you had the limit order in at $70, and somebody came in there and sold it at $69.9999, and you never got filled, the market moved away from you. If you're adamant with your broker about that, those things make a difference. That does have impact on what's going on. And I would be very vigilant on trades that had suspicious fills.
Okay. Cameron's asking if we redefine it as medium frequency trading for the retail trader. What do you think that it would take? Is it every few seconds? Is that competitive enough for the average retail guy to compete against anybody, or are they just fooling themselves?
I think that's getting into the realm. It depends on the movement in that period of time. I guess you want to just build in a lot more slippage than the market's telling you, or actually just use your actual real slippage results versus what you're seeing.
Ron has a question for the regular DTN IQFeed customer. So, how, in terms of latency, do you guys know? What am I looking at? I'm in Dallas. I think that I don't know where your server is. I don't know where my data is coming from, to be honest. So, what's the latency? How far behind the mark am I?
Yeah, it's difficult to say. If you're in Dallas, you'd be connecting to Omaha. And so it depends on who your ISP is, where their peering points are. There's a lot of factors in that. So,
let's say that my
across the street might have quite a bit different times.
Okay, but let's say my ping is 40 milliseconds to my broker in Chicago. Am I looking at 50 milliseconds on the data? How the time it takes for you to get it from the exchange and process it and send it out to your ticker plants? how much further behind the curve am I, do you think?
Well, I think the speed of light is probably the bulk of it. Like 90% of your latency is going to come down to speed of light, which is your ping.
Right. And let's say that I co-locate in Chicago and I want to do the best that I possibly can, you know, for my size as a small trader, and you know I have a less than 1 millisecond ping to my execution broker. Do you guys am I going to connect to Chicago ticker plant, or do I need to do something else to get faster quotes?
With IQFeed, you will connect to Omaha, yeah.
You know, one thing that we have seen working with our developers is the time that the quote gets to your port on your machine is one time, but you can easily blow 10 times that amount of time on getting that quote into a state where you're actually processing it in your machine, like
right.
handing it off between a receive thread and the CPU thread, or converting, you know, one format to another, or stuffing in a database and having another program
right.
pull it out of that database. We've seen many examples where people were concerned about 10 milliseconds, and then at the end there was this, you know, there's some process in the middle that added 500 milliseconds onto it.
Yeah, very good point.
And that's one thing that, you know, everybody throws a lot around milliseconds and latency, but you've got to be realistic in what you're trading. I mean, we've got guys that will call us up and say, I've got to have single millisecond resolution, but they're trading off of a chart. So they're an eyeball trader, and your eye isn't going to differentiate anything less than 200 milliseconds.
Right.
So if you're trading off of a screen and you're trying to beat somebody that's 10, 20, even 50 or 200 milliseconds, you're not going to be able to do that because you can't make that decision.
Dennis asks the question. He says, how do exchanges get away with providing these special order types or special order information only to certain clients when under the Exchange Act of 1934, I don't know of this, maybe you guys do.
I do.
Okay, their franchise require them to maintain, quote, fair and orderly markets.
Yes, yeah, that is the language that's repeated throughout and throughout the Reagan MS and 1934 Act about how exactly that. And that's a question for your congressman. You need to develop a relationship with him or her, and write them a letter and express your concern, because that's the only way that will change.
And I have a question. Have you ever interfaced with any of these regulatory bodies or Congress guys? Have they ever phoned you up and asked for your input?
Absolutely, yes. All of them.
Do you get the sense that they're actually going to do something, or was it just for show?
I believe it was all for show now. I gave a presentation to FINRA just a few months ago, and the question and the answer period afterwards was pretty scared. The level of what they knew and what they thought and how or they just wanted to sweep it under a rug. I mean, it was just really eye-opening.
There's a lot of education that needs to be done.
Right. Okay. I'm scanning for more questions.
I've actually got to drop out here in a few minutes.
Okay. Thanks, Eric. I think we're actually coming to the end. I'm just looking for any questions that we haven't already covered. Give me just a second here. Mike wants to know, is tick and trend or other breadth indicators like that, are they affected by HFT? I guess the answer would be it's just like everything else, right?
Yeah, because they're a derivative of the underlying that would be.
Yep.
You know, one thing to keep in mind, one advantage you have over HFT is that they're basing all their information and strategy on existing prices, and you have the ability to bring external information to the table. For example, that's where you want to focus on that.
Right. I think the underlying message is that if you're not an institution, if you don't want or need or have to play in this game in order to make profits, then don't. Stay far away. Increase your time
frame. The goal
frame.
is to make money.
Yeah.
Or buy long term and don't use stocks.
Yep. Let's see. Okay, so I think the consensus is that hide not slide is not available to me and you. Okay. Do you guys have any specific book recommendations on how to go about just making your own algorithmic trading bot? Not HFT, but any good books that you'd recommend, or just if you want to learn more information on HFT in general, other than Scott Peterson? Is there anybody, or is it Peterson or Patterson? Patterson. Any other books you guys recommend?
I think Demas, Joe Saluzzi, and Sal Arnott just came out with Broken Markets, which is kind of, the more you understand of what's going on, the easier it is to figure out why your trade executed where it did. I think that,
Irene Aldridge also has a book that came out about a year ago on HFT.
Right. Harold says the 15C3-5 is taking it from 250 milliseconds to 1,000 milliseconds. I don't follow. Does that mean anything to you guys?
Yeah, that's the risk control that they put in place to stop naked access.
And you're saying that that's a requirement now, but I thought that
November, yeah.
Oh, okay. So it's not yet. So that's just another speed advantage.
Last November it was implemented. Yeah.
Oh, okay.
Last November.
So that's just another. So it's mandatory. They have to go through risk, even though they know there's no need.
Yeah. So as a retail broker, you're going to get an extra step involved in before you can get your order to the matching engine, whereas some of the HFTs that are right there, they might have a faster system.
Right. But if you're Goldman with endless pockets, or JP Morgan, do you really, they're actually forced to do this step, and I guess they just made it like an automatic green light or something to make it as fast as possible?
Those now are down to microsecond level.
Right.
They're FPGA programmed right in all those risk controls now.
Right. I'd like to see under what circumstances it actually declines the trade. Okay, that actually covers all the questions. So, Eric, you mentioned you got to go, so I really appreciate you stepping in today and answering some of these questions. I thought this was a fantastic webinar. I loved this topic. I definitely want to have both of you guys back. And Jerry, do you have those slides, the questions to give away these 3 6-month subscriptions?
Mike, I'm going to drop out. It was my pleasure.
Okay.
Care.
Yeah, thank you, Eric. Thanks.
So the first question is, what is the term used for sending a large number of quotes?
Okay. And I've got the answer, so I want to remind everybody that the way that we do it is the first person to answer correctly on question 1 will win. The second person for question 2 wins. The third person for question 3. So I guess I should ask, I want to confirm, what is the answer, Jerry?
Quote stuffing.
Okay, that's what I thought. Just making sure. And Danielle Rolls, I need your BMT username, please, if you would type that in. Give me just 1 second here. And I will contact you once the webinar is over and get your contact information over to IQFeed. Okay? And the second question?
What is the term used for allowing somebody to submit an order without risk controls? We just talked about
it. I'm not sure if we've got the answer yet or not, so I'm going to give it another second here.
Okay.
All right, what is the answer?
Naked access.
Okay, let me find the second person to say that, and that would be Lusa Lynn. Lusa Lynn, I need your BMT username, please. So naked access, what's the answer? Okay, great. And now the third question.
How many different market centers can an equity be executed in the U.S.?
Okay, and what was the answer?
50.
Okay, give me 1 second to find that. There's 1 and 2 and 3 is Richard Pask. Richard, I need your BNT username, please. Okay, so congratulations, guys. So the prize was
We'll do number 4 and do a 4th bonus question.
Oh, okay.
Who is your favorite data provider?
All right, hang on. Everyone stop, please. My flying off my screen here. So I think we know the answer to that one, and I just got to find the 4th person once my screen stops moving. 2, 3, 4. Harold Lanier, Harold. I need your
Harold
BMT. Lanier. Okay, there we go. What's your BMT username, Harold? All right, so while I'm waiting for that, so congratulations, guys, for those prizes. Thanks for making it 4. That's always great. And I wanted to clarify, so you're giving away the $85 a month package. It'll be free for 6 months. And in order to make sure that these guys pay nothing, they need to get the CME fee exchange waiver, right? So as long as they have an active account with almost any broker, that should happen, no problem, right?
Correct, right.
Okay, so as
long as you don't have PFG. Did anybody have PFG?
Yeah, that's a good point. Okay, so
we've got a lot of partnerships with you if you want to move from somebody else to them. Just check with Robert.
Right. Okay, so the 4 winners, congrats. I'll send you a private message here in just a couple of minutes, and just keep in mind that if you don't have an active account, that there is a CME fee. So you probably either want to get an active account or you want to wait to cash in your prize to avoid paying those fees. All right, so Jerry, again, I really appreciate it. Sorry that we couldn't do this a couple weeks ago, but I'm happy that it has happened today, and I would definitely like to ask you guys to come back and talk about something else in the future. It's always great. I really love this webinar. It's a ton of fantastic information and gives us a rare opportunity to get some of this insight and to be
okay. I appreciate the opportunity too.
Yeah, be better connected to all these things. All right, guys. So I will post the recording for the webinar sometime tomorrow on the site, and you can see it on BMT. There's also a thread, so if you guys have any questions that didn't get answered, you can post them in the thread, and I'll try to forward those over to Jerry. Thanks, guys.
Thanks a lot.